Welcome back to Capital Ideas, where we celebrate the ideas that make our lives better and the capital markets that make them happen. I'm Nick Morgan, the co-host of today's episode and the founder of ICAN, Investor Choice Advocates Network.
And I'm Dara Albright, co-host of Capital Ideas and proud board member of ICAN. And please join us in welcoming today to the episode Rebecca Kacaba. Rebecca is the CEO of DealMaker, a leading capital raising platform, and has been consistently rated in the last couple of years one of Canada's fastest growing tech companies overall. Welcome to the show, Rebecca.
Thanks so much. Thanks for having me, guys.
Yeah, really excited to talk to you.
Yeah.
And really with your expertise and insights on the capital raising side, we thought maybe the first question to you is, how difficult would you say that it's been for smaller issuers and investors to access capital?
Yeah, listen, I mean, Dara, I've been working with entrepreneurs my entire career, right? When I was a lawyer as well, back before I co-founded DealMaker, a technology company. So over 25 years in the capital markets, and I've watched firsthand how difficult the capital raising process is for entrepreneurs. If you just look at the stats, right, 78% of small business owners are concerned about their ability to access capital. And 90% of new businesses with employees are going to need external capital at the start. So that's always been my primary focus, and how my career journey led me to founding DealMaker, to make sure that more companies and founders could get access to capital to get their businesses started.
And so, I know you talk a lot about democratizing access to capital. So I want to jump into that a little bit and get even more of your insights. But how does the ability of having a platform that is, more friendly to smaller issuers and smaller investors, how does that actually drive job creation, economic opportunity, et cetera?
Yeah, well, let's take it from the base level, right? More businesses means more jobs for more Americans. And we have Silicon Valley that started out, and VC funding really became a thing back when I was a junior in the law firm days, maybe 10, 15 years ago. But actually, less than 1% of startups in America are funded that way. It's a very specific business model, and it's a very specific return that those investors are looking for. And as we said, you've got over 90% of new businesses with employees that are looking for access to funding. So if you look at it, right, 63% of the new jobs in America are created by small businesses. Small businesses are really the lifeblood of where Americans are getting their jobs and making the money to feed their families. And 43% of the US GDP is funded by those small businesses. So we've got a really important core element of the economy that needs to get funded so that we can continue to have jobs. And democratizing access to capital really allows more of those businesses to get funded so that more economic activity can occur. If you look at Reg CF, for example, over 70% of the businesses that launch those funding rounds are actually hitting their funding target. That's tremendous. You can go out, and I know from all the founders I've worked with, you can go out on a roadshow and pitch all kinds of funds and VCs and come back with nothing if you don't have the right business model. But if you look at over 70% of companies actually meeting their funding targets in Reg CF, that's an enormous success rate. Then what I love about it is the way that over the time period that I've been involved in this category, we've seen some really interesting stats emerge. So while we know that less than 2% of VC funding goes to female and minority founders, over 30% of the founding teams that get funded through crowdfunding are female and minority founders. So if you look at it, this is not only providing more small businesses getting funded and growth companies too. At DealMaker, we do a lot of growth companies, but we're looking at a much more diverse set of people that are getting an opportunity to start a real business that might create some real differences in the economy. So I'm really excited to see what happens 10 years from now when these businesses start to take off. On the investor side, I love what's happening too, because I always like to put it to a real life example, right? If you have an American family that invests $1,000 in 10 deals, right? They just spent $10,000. If only one of those deals, 300Xs, they've now made $300,000. That's material life-changing wealth. And right now, those are the kinds of opportunities that are really only happening for VCs and hedge funds and folks that have a lot of economic power already. So if you give the average person access to those kinds of private company returns, now we're really talking about initiating some really cool change in the American landscape.
And narrowing the wealth gap.
Love that.
That's right. That's right.
That's how it happens, right? You can't do that without giving people the opportunity for those 300X returns. And we know, like, Dara, you know, you wrote about this the other day, right? That's going to come with some risk. We all know that. There's no one but me that's a bigger advocate of doing this safely and the right way. But you can't just, in today's day and age, prevent people from having opportunities and say it's for their benefit. We have to think a little bit harder than that.
And Rebecca, this is obviously resonates very well with Dara and me, at ICAN. But there is a prevailing view among some that the best way to protect average investors is to prevent them from taking risk. It's sort of the protection through prohibition model. We'll just lock you out of certain investments and you won't be exposed to those risks. So one of the things we're focused on at ICAN is identifying those kinds of regulatory barriers that keep everyday investors or small entrepreneurs out of the markets. And we try to, break them down. Can you give us an idea? What are some of the regulatory barriers you've encountered that are either you find particularly problematic or that deserve more attention than they're getting?
Yeah, I think that's a great shout. And before we even look at the regulatory barriers, I think my response to that is, are we not going to let them gamble then? Like,
Right.
are we going to prevent FX trading? Are we saying that NFTs are illegal? Because people are looking for these high risk gains. They're saying that they need them. And there's lots of unregulated categories where this stuff is going on, right? Crypto market is one whole area. Let's not open that ball of wax. But like these high risk returns are being pursued in other categories. So let's be realistic about bringing them into the regulated space and doing that in a safe way that people can actually make money. So I'm really excited about a lot of the new changes that we just saw come out with Bill 2799. Patrick McHenry sponsored. He's been a huge advocate of this for a long time, and we're really excited about it. Some really interesting changes to the exemptions that we are excited to see. Microcap offering exemptions, right? So people raising less than 250,000 who can do that in a much more streamlined way, because I've seen it over the cost of capital. Look, that raising such a small amount as 250,000 can be really prohibitively expensive, right? And if it's too expensive and the cost of capital is too high, then it's not going to be a good return for the investors. So we have to make sure that the amount of regulation is not so overbearing that when companies go to raise, now investors can't get a return. So I love that change because that really recognizes that principle and is really opening up the economy for those businesses that need less than 250,000 and they want to make a go of it that way and get their investors some returns. The other thing that I love is some of the changes for crowdfunding portals. So the rules have been around for a long time now, and recognizing and streamlining things for crowdfunding portals is really important, right? Because it's still relative. This space has not been around that long. We're talking about, just over 10 years. And the pioneers who are bringing forward these crowdfunding portals have a huge amount of obligations on them, and they've got to make a business run through. So anything we can do to make the crowdfunding portals have an easier time and a more streamlined time so that they can get companies funded is going to be a multiplier win for the ecosystem as a whole. And then secondary trading, right? We get into the liquidity markets. We need that to happen in a streamlined way as part of folks getting a return so they can reinvest back into the space. And so streamlining things for secondary trading is really important for the ecosystem as well.
Those are all issues near and dear to our hearts. I'm going to ask, this is a little off topic here, maybe, but one of the issues we're starting to look at is the role of auditors and what the regulations require in terms of either accountants or auditors. And it seems like there's been a lot of discussion about sort of scalability. In other words, needing more involvement by an accountant or an auditor the larger dollar amount you're raising or the more investors you're involving. Is that an issue that you have come across, and have you seen good solutions to that issue?
I think that's a really good point to raise because that is something we see companies struggling with a lot, right? If it's an early stage company that's basically done a little bit of activity and there isn't a huge amount of business operation, that's just an additional hurdle, and the audit really shouldn't be necessary. And so you can raise up to a certain amount without the audit, but ultimately people are trying to hit the 5 million mark, so they do end up needing an audit. And getting access to an auditor becomes hard and cost prohibitive in a lot of ways. So definitely thinking through the scaling of when the auditor needs to be involved and exactly what they need to do, I think is a very natural evolution of the rules.
Yeah, yeah. Well, this has been terrific. Dara, unless you have anything else.
I would just say I'm amazed by the stat that you brought out with 70% of the Reg CF companies meeting their targets. I mean, that's pretty incredible. I don't think most people know this, but when Intel went public in 1971 at a 50-something million dollar valuation, I might add, they actually missed their first quarter.
Interesting.
Yeah.
Yeah, a lot of folks do. A lot of folks do.
Right. Yeah. Well, Rebecca, thank you so much for being on. Dara, thank you again. And for everyone else, please join us on the next Capital Ideas. And if you want more information about ICAN, go to icanlaw.org. And I think we'll leave it for there. Until the next episode, goodbye.